Oh, hi everyone, and welcome to today's Forex session. Oh, we are almost on time, just a minute later than usual, and hopefully you can hear me and hopefully you can see my screen as well. And I'm going to ask really it's a stupid question, but can you actually hear me? And if you could put a yes in the chat box, that would be very much appreciated, and that you can see the screen as well. David, can you see it? Yes, absolutely fine. Thank you, Malcolm. Well, David can, so brilliant. But before we start with the charts and what's been going on and what is going on in the forex markets, may I just draw your attention to the disclaimer that I know you can see on your screen, and just remind everyone that trading can be a very risky business. So please don't ever think of using money that you cannot afford to lose. Right. I think I'll just put the I'll put the chart. The chart. We'll watch the chart while I just give a very brief overview, and it is very brief, of what we have to be aware of this week, and also the time of year, because we are in a bit of a not a curious period for trading, but there are certain, if you like, factors that are going to affect the market certainly this week, and we've obviously got the 4th of July holiday on Monday. The first thing, of course, it's end of month, it's end of quarter, and it's end of the half year. And what can happen at this particular time, when you have these three dates all coinciding, is you have rebalancing. So you have price action in equities doing maybe all sorts of not strange things, but it isn't normal. You might find more price action might be a little bit more volatile, and also with the forex market, you tend to find more flows into the US dollar. There's quite a lot of buying towards the end of the month. And the last thing you have to add on, as I said, this is the week that we, prior to the very important 4th of July holiday on Monday. And whenever you get a holiday weekend with the US markets, you tend to find they like to end the week going into the holiday on a positive note. So Friday, we will be looking for this positivity, this positive sentiment to be reflected in the price action for risk assets such as stocks. Now, of course, you're thinking, well, hold on a minute, all this positivity, buying stock, hey, hold on, have they totally deluded? They had a good delusion, given what is happening in the real world, in the sense that obviously we have inflation, we have the war in the Ukraine, we have, what else is there, David? I'm trying to think. We have the, pardon? Oil. We've got the cost of living crisis. There's a whole laundry list of things which would suggest that, totally contrary to, as I said, this sentiment which may be apparent by the end of the week, because they want to end the half year, and as I said, the holiday coming up. And it's just one of these situations, one of these times of the year. It's a bit like the Santa rally that we have in end of December going into the new year. And sometimes, you see things on your chart, and you've got this in the background because obviously it's all been written about in the media, and you think, my goodness, I'm seeing two different things here. I'm getting a message from the media that's giving me this picture, but actually, what am I seeing on the chart? And really, you kind of have to adopt a bit of cognitive, you have to accept the cognitive dissonance that is going on in your head and go back to the chart, see what you see, trade what you see, and if there's an opportunity that comes up that is possibly contra to, as I said, all the messages that are out there, just take it. Still be aware, possibly maybe not stay so long in the position that you get yourself into. As I said, it will, it will pass. Things will kind of become more normal in inverted commas. And of course, once the 4th of July holiday is over, we then go into the summer months. And traditionally, the summer months when everything quietens down. Now, whether that happens this year, given everything else that is going on, well, that just remains to be seen, and we have to just play it by ear, basically. Now, with regard to this kind of risk events that we have today, I just quickly bring up the calendar because everybody seems to be out. We've got Powell speaking today, we've got Lagarde, we've got Bailey, we've already had Mester, we've got an OPEC meeting, and we are, there's the last of the fundamental releases coming out. We've got the ISM, I think, on Friday. And what's also happening, the other factor to bear in mind, as I said, in this contradictory picture that we're seeing, perhaps between what we're seeing on the charts and the narrative that we're reading about in the media or hearing, is that releases such as I think we had the Richmond, we had what was it? There was another release that came out, which were basically the PMIs. That's it. They're all really, really poor numbers. They're all pointing to a recession. Again, whether that happens, we will wait and see. But the interesting thing with that is everything is doom and gloom, as I've outlined. These bad, these bad numbers, this bad data is coming through. The question is the Fed actually going to be able to continue to raise rates aggressively? If they don't, and if they pull back, that's actually positive for stocks. As I said, it's one of these sort of contradictory, kind of paradoxical situations. So as I said, there is actually a lot going on. Now, if you're a euro trader, the thing I would recommend most strongly is that you really, really keep a very close eye on what the ECB are up to. You may have read, you may have heard that they're also scheduled to raise rates, start raising rates back, I think in September, and they've now come out. Lagarde said they've come up with what they call an anti-fragmentation tool, which is actually quite worrying because they seem to, are they suggesting that there is some real problems with the euro? We know there are problems with the euro in the sense that, the currency that it's set up in the way it's set up ultimately does not succeed because you need political union and more importantly, you have to have debt union. You can't allow individual members of the euro to simply go their own way. You have to pool everything, and that's what they haven't done. And a currency that's been set up in the way the euro has, ultimately it won't succeed. Now, this fragmentation, are they that concerned about it? Market hasn't really responded so far, other than the euro has been selling off, but then that's more because the dollar has been quite strong. But it's just one of these things to be aware of. And no one really knows what this anti-fragmentation tool is, or tools are. But if you are in the euro and you do like to trade it, it's a case of really keeping a very close eye on what she says and what other members of the ECB say. And that goes for whatever currency. If you are a trader that likes to trade a particular currency, we always suggest, you really have to get to know it. What shifts, what are the factors that actually move that particular currency? I'm actually going to pass over to David because I want to do a little session a little bit on the Aussie dollar, for a number of reasons. It's really to look at using multiple levels in multiple timeframes, looking at how to combine the Renko with the time chart for reversal. I did take a screenshot because with the Aussie dollar, and also it's been a great example today where there was a really nice trend lower, that had been going on, and it came in. It was going along quite nicely up until the London Open, and then it sort of all went a bit haywire. And again, it's just to reiterate what David and I always say is these crossover periods, the half an hour or so leading into when a new financial centre comes on board. In this case, it's London. They can. Trades can be very vulnerable to the volatility that sometimes occurs, simply, positions being closed out from the previous center and new positions being instigated. And a lot of traders just aren't aware that, you can get this, as I said, this additional volatility. And if you're in a trade, you think, oh my goodness, well, what's suddenly happened? And this is why you have to use, first of all, multiple time frames. First of all, be aware, multiple time frames. And it's just been a really nice example. We've had some nice example with candle patterns. We can see here. This is the reversal that we're seeing on the Aussie dollar. If you combine those two candles, you've actually got like a hammer. But if we go up to the 15-minute chart, what's also very important is in this this move lower, the volatility indicator was triggered. Why was it triggered? Because the price action in that candle was outside of the average true range for this time frame. And then what do we get? We get an immediate retrace within the spread of the candle. And if you put that candle over there, you get you get a deep lower wick. You've got those two, a lot of volume going in there. Hits a volume support from the volume point of control. It's all these little factors that you have to put together, as I said. So first of all, on the macro level, what is going on at the macro level? Just be aware of where we are in the trading week, in the trading month. We've got a holiday coming up, and then you focus it down to what you're actually seeing on the chart. But as I said, I'll cover that in a little bit more detail. But I just want to pass over to David, because I know I think you've got the yens there as well. And I think the yen is a perfect example of probably what I have been saying. So I will pass you over. If you've got any questions, please just add them into the chat box. We'll be more than happy to answer them for you on anything that we have said. I'll pass over to you, Laurie. Here we are. Here we are. Sorry.
Hi everybody, and hopefully you can see my screen, which I think you can. Hopefully you can hear me as well. So just move the chat box out of the way. Just very quickly, I wanted to show you this. This has been a really nice trade this morning. If you've been in it, fantastic. If you've got a basket running in yens, terrific. This is the Swiss yen. I've got it on multiple time frames. I've got 15-second at the top. I've got 2-minute here, 3-minute, 5-minute, 15-minute, and daily. I'm sure many of you have seen this many times before. It's just a really nice example of many different aspects of trading FX. If I just pull up this is the 15-minute, this is where we were. And the nice thing with NinjaTrader is, unlike MT45, which can be a bit of a pain in terms of trying to demonstrate where you are time-wise, because it often runs 2 hours out of sync because of various reasons with regard to where the servers are based. But in terms of NinjaTrader, it actually tells you exactly where you are. So this is 8 o'clock our time. So basically this is the London Open. It's now 12:15 here, more or less. So this is where we are in real time. We had the London Open come and go. We had a volatility candle, fine. They happen, as Anna said, you get them at crossovers all the time. You'll also get them at 7 o'clock here, these sharp moves. You just have to wait and be patient. This was just a classic example. Got a volatility trigger. What happened? Reversed inside the candle. Then we track on, almost down to 9 o'clock. Then we get a big hammer candle here. Decent volume under that. But the key is, until it clears the top of this original volatility candle, you can't be absolutely certain what's going to happen. But once it starts to move higher, yeah, we had falling volume, so it didn't look great at that point. But then the key is whether it's going to break above this level here, we've got all these little levels which are clustering together on the accumulation distribution. So they're basically combining strength, if you will. The thicker the line, then the greater the strength of support or resistance. But when you get minor levels like this, but when they're clustering together, then they do actually create stronger levels of resistance support by virtue of that clustering effect. So once you start to break through that level, then you've got a good platform of then support in place below you, and it's an opportunity to get stuck in. And we've literally had a whole run of consecutive green candles, really nothing very much to signal that we're coming through to weakness, other than we've had some weakness appear here, and we're now right at the top of this. And several aspects to that in terms of, is it time to exit? What is going on? Obviously, the 15-second is very quick. I'm not suggesting you go to the 15-second, but you start to look at what's happening on the other timeframes. And the other aspect of multiple timeframes is when you look at the trend monitor. The trend monitor is just a fantastic tool for helping to keep you in through those periods of price action where the price congests. Maybe you start to think it's going to reverse a little bit, and particularly when you use them in multiple timeframes. And you can see throughout this phase we've had blue, 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 right the way out to the daily as well. So the whole lot just confirms that we are in a very strong trend. It's confirming across the timeframes. The trend monitor is confirming. And when you also step over onto you can see on here, just before I move away, this is on 5. This is the Swiss yen at the top. This is Swiss franc at the top. This is the yen at the bottom. And that's basically what we've been seeing. So if I move over onto the currency strength multiples, drop that out of the way, that's still what we're seeing. This is 15 minutes, so this is the slowest time frame here. So I've got 1 minute, very quick, obviously. I've got 5 minute, 10 minute, and 15 minute. With the Swiss franc now heavily overbought, right up into the top here at 92. It could go a little higher. It could stay there for a long time. As it is here, it's flip-flopping around. Equally down at the bottom end, we've had this is a yen, which is selling off very strongly. It's still selling off strongly here on the 15-minute time frame as well. So a little bit further to go. But if you've ridden that ride all the way throughout this morning, you'd now be looking at thinking of this, and well, do you know what? Maybe it's time to exit, not purely based on what the currency strength indicator is telling you, but also perhaps based on the chart, what that might be telling you in terms of some short-term weakness coming in. Also, the fact that we're now 30, 40 minutes away from the US Open, and that is often a time at which these trends in one session, one block of time, a 4-hour period, and this is another facet. You'll see London Open and you'll see a strong trend develop, 8:30, 9 o'clock, and that'll run 12:30, 1 o'clock, and then the US markets open. And often you will see that trend will then completely reverse as the US markets take a completely opposite view, or they have a different sentimental view, not a sentimental view, a different view of sentiment. So you put those factors together. If you've been riding this trade for 3 or 4 hours, then you might come to the conclusion that, do you know what? Putting it all together, it might well be time to come out of that one. Let me just run over onto the array multiples here as well, because what I've done here also is really just to highlight that trade out. Again, you've got a 1 minute very fast. You can see the Swiss yen is up here at the top. So I've isolated out on the yen, very heavily overbought here on the 3 minute, and very strong up here on the 5 minute. And there's also signaling on the 5 minute that we've got potentially overbought situation arising anyway, which is what you imply from everything else in any case. But it just gives you another confirming facet. But what the currency array gives you is it gives you that sense of sentiment, because if you're trading the Swiss yen, then you want to be assured that the yen is being sold universally, which in this case it is, because all the other pairs are pointing upwards, which is what you want to see. Now, obviously, what you're seeing here over on the 1 minute, and bear in mind this is a very much faster time frame than everything else, but what you're starting to see is perhaps a little bit of a weakening of that sentiment, because the pound yen is now dropping away. Maybe the dollar yen is going to fall away, and gradually over time, if that sentiment has indeed reversed, then you will see that on the fastest time frame. So all of these will start to swing down to the opposite side, if you like, move through the midpoint here and down to the other extreme as that selling becomes buying. And if that trend is strong enough to change, then it will obviously filter through. So it'll go from the 1 minute through the 3 minute, 5 minute, in exactly the same way as it would do on a chart. And the nice thing with the yen is because the yen is always the counter currency, you get this very clean visual on it. So it's very easy to see. You haven't got to think of inverse currency pairs where you may be looking at other pairs which are upside down working on an inverted basis. Here they all work in the same way. The yen is always the counter currency. So in terms of looking at the currency array, this is what you always see with the yen. If the sentiment towards the currency is universal, they will all be to the upside, pointing higher, or they'll all gradually swing lower to the downside and move lower. Now, what's interesting about this at the moment, very quickly, and then I'll hand back to Anna, just go back to see where we are, see if that's actually come off a little bit. Yeah, it's pausing a little bit, starting to see a little bit of slowdown. And what you'll see in the trend monitor here is you're seeing some congestion coming in, so you've got some color changes going on here. Now, if that is going to truly change on these slower time frames, the 2 minute, the 3 minute, out to the 5 minute, in other words, is the Swiss franc here going to start reversing lower, and are we going to see yen buying? You know, then that is what is going to be reflected both in terms of the chart, in terms of volume, and also in terms of the indicators here on the downside. Now, what's interesting is if I just pull this over, this is actually the VIX, which I've got on 5 minutes, and this would be another reason, in my view, that it will be time to exit that trade, because the VIX is now starting to tick up a little bit, and it's not what you want to see, because if you're buying the matrix pairs, in other words, you're selling yen, then ideally you want to see the VIX falling. You don't want to see the VIX rising, because the VIX rising is telling you that you know, it's a risk-off environment, not a risk-on environment. So the VIX is ticking up a little bit. It's not ticking up very aggressively, but it's certainly, you know, maintaining that level. Just scroll that back a little bit just to show you where it is. So that's where we are at the moment, a little bit of a gap up here. So, you know, it's another reason. Obviously, you've got in the back of your mind, you've got to have the fact that what's going on in terms of indices. You'll be looking at the indices themselves. Sorry, let me just go onto that one. Just flick down onto the indices, see what's going on. This is the US markets, 5 minutes in the daily. That's where they are at the moment. This is on the daily. I'll do a lot more on this later on in the later session, but you know, essentially, it is looking, you know, really weak at the moment. The broad economic outlook is based on these very high inflation figures, which have just really overtaken all central banks. They are all running to catch up. They're all well behind the curve, as always. And speaking of curves, all of this is reflected in yield curves. If you're looking at the yield curves, then you are starting to see a flattening. You're starting to see inversion coming in, both in terms of euro dollar and also in terms of treasuries. And really putting that all together, you know, it's not a great picture. How the Fed and other central banks are going to manage it, Lord alone knows. But somehow or other, they're going to have to try and get inflation down. And it's going to be messy, and it's almost certainly going to go into recession. There's probably going to be stagflation, if not depression. It's not great news over the next 12 months or so, but we will see what happens. We've been talking about this for a long, long time, and we were flagging the rising inflation results last year, and everyone else has picked up on it. But you know, that's the way it is. And as always, the central banks are behind the curve. Limited tools that they have at their resources. Let me pass back to Anna,